All right, welcome to this explainer. Today, we're locking in on the absolute ultimate key to surviving the financial markets. Most traders spend like 95% of their mental energy obsessing over exactly what to trade, chasing a chart pattern, a breakout, or some crazy news catalyst. But here is the brutal truth. Position sizing, literally how much capital you allocate to a single trade, matters just as much, if not way more. If you master it, you build an absolute fortress around your capital. But if you ignore it, well, the market is going to eventually take everything. Okay, let's dive into this because it's kind of the core paradox of retail trading. Why do so many traders with mathematically winning strategies still manage to lose all their money? Well, you can have a totally brilliant strategy, but if your position sizing is off, you're still going to lose. Why? Because when a position is just way larger that you can comfortably manage, every single tiny price tick feels existential. A small dip triggers anxiety. A normal market noise sparks absolute panic. Fear makes you exit early, and frustration, that leads straight to revenge trading. I mean, we've all been there, right? White-knuckling the mouse, just praying for a bounce to recover losses by making increasingly risky decisions. In those moments, your emotions completely override the math.
So think of today's explainer as your personal survival manual. We're going to run through this step by step. First, the risk of ruin. Second, the math of survival. Third, training your trading muscles. Fourth, calculating your position size. And finally, staying in the game. Let's get into it.
Starting with Section 1, the risk of ruin and capital survival.
In the world of professional risk management, trading is basically viewed as a capital survival problem. Look, if you don't survive, your performance metrics honestly don't matter at all. The risk of ruin is this probability-based metric that estimates the actual chance you'll completely wipe out your trading capital over time. Now, it is absolutely crucial to understand the difference between a drawdown and total ruin. A drawdown, that's just a temporary, mathematically recoverable dip in your account. But ruin, that is a permanent loss state where the chances of recovery drop to practically zero. You are literally out of the game.
So, the crucial point is the terrifying asymmetry of capital loss. Losses and gains just do not behave the same way. As your losses deepen, the return you need just to break even skyrockets exponentially. Think about it. If you take a 50% drawdown on your account, you don't just need a 50% gain to recover. No way. You need a massive 100% gain just to get back to square one. Take a 70% loss, you're looking at needing a 233% return. That right there is the mathematical point of no return. And we've got the hard proof right here from Aaron Group's data. Look at this. If you have a 40% win rate and you risk 5% of your capital per trade, your risk of ruin is literally 100%. It is a mathematical certainty that you're going to blow up that account. But drop your risk down to just 1% with a 60% win rate and your risk of ruin plummets to just 1%. The big takeaway? Having a high win rate doesn't guarantee your survival if your position sizing is way too aggressive.
Moving right along to Section 2, the math of survival and finding that sweet spot. Okay, so if risking too much essentially guarantees ruin, how do we find the mathematical sweet spot? Enter the Kelly criterion. This formula was cooked up by John Kelly Jr. over at Bell Labs and then famously unleashed on the markets by hedge fund legend Edward Thorpe. It's designed to find the exact position size to maximize your long-run account growth. It basically balances your win rate, that's the W, against your payoff ratio, which is your average gain divided by your average loss, or R. In plain English, the formula is just telling you to allocate more capital when your edge is huge and back off when your edge shrinks. But all right, here's the catch. The classic formula spits out what we call full Kelly. Now, under perfect theoretical conditions, it's optimal. But in reality, going full Kelly could mean risking 30% or more of your account on a single trade, which leads to these absolutely brutal, stomach-churning equity swings. And that is exactly why almost every professional out there uses fractional Kelly, like a half or maybe a quarter of what the formula recommends. It keeps those swings totally manageable, preserves your capital, and, humbly acknowledges that our estimates of our own trading edge are usually a bit flawed. Now, what's really interesting about this slide is the famous trading adage, fat tails eat optimizers for breakfast. Real-world markets are messy. They go through sudden regime shifts, extreme, totally unpredictable shocks. Those fat tails happen all the time. An aggressive math model that just assumes constant predictable odds, it's going to get absolutely destroyed by real market chaos. And this is exactly why the pros always pair tools like fractional Kelly with super strict hard limits on their overall risk.
All right, Section 3, training your trading muscles and the importance of emotional discipline. Let's shift gears away from the heavy math for a second and talk about the human element. Because honestly, knowing the math and actually having the emotional discipline to execute it are two very different things.
Think of position sizing a lot like going to the gym. If it's your first day, you're not going to walk in and try to deadlift the heaviest weight on the rack, right? Your body just isn't used to it. In trading, you have to actively train your emotional muscles to handle larger numbers. You start small, say a $1,000 position size. You trade that consistently for a few weeks, then you evaluate how you handled the wins and, more importantly, the losses. If you kept your cool and maintained discipline, then and only then you scale up slightly, maybe 10 to 20%, up to $1,200. You literally have to slowly acclimate your brain to the size of those monetary swings.
And adaptation is totally key here. A changing market absolutely requires a changing position size. Take this, for example. When the Federal Reserve is speaking, markets usually get super choppy and low volume while everyone just sits on their hands waiting for the news. Professional traders don't stubbornly trade their full size in that kind of environment. Nope, they proactively slash the position size by 50 to 70%. That way, if they take a hit, it's just a fraction of their usual loss, which protects their absolute greatest asset, their confidence. Doing this creates a really profound psychological edge. Using smaller, measured sizes just completely eliminates that existential dread of watching every single tick. It stops revenge trading in its tracks. It gives you the actual psychological breathing room you need to focus on the quality of your analysis, instead of just panicking over the size of a potential loss. Real consistency comes from knowing your losses are completely manageable, not from some false confidence that you're going to win every single time.
Which brings us to Section 4, calculating your position size. Let's run the numbers.
Let's make this super actionable and look at the exact formulas you need to use today. A foundational pillar of risk management is the 2% rule. But wait, let's clear up a massive misconception right now. The 2% rule does not mean you just buy an asset using 2% of your portfolio's cash. Not at all. It means you structure your trade so that if your stop loss gets hit, the actual cash you lose equals no more than 2% of your total portfolio equity. So you take your max loss, divide it by the max downside percentage of the trade, and boom, that gives you your exact perfectly scaled position size.
And this brilliantly illustrates exactly how you calculate that maximum downside, because you need a smart stop loss. Take a look at this chart for Rocket Pool. With the price coming down to test a support zone around $25.50, you don't just stick your stop loss right on the line. You place it slightly below the structural support level, down around $24. Doing this keeps you from getting stopped out on those minor noisy dips while still totally protecting you from a catastrophic drop.
Now, once your stop loss is locked in, you calculate your reward to risk ratio. In this setup, if we enter at $5 with a stop loss at $4.60, we're risking 40 cents. If we target $5.80, that's a potential profit of 80 cents. So that's a 2-to-1 reward to risk ratio. And securing a favorable ratio like this is huge because it ensures that even if you only win half of your trades, your account is still going to grow steadily over the long run.
Let's move to and see how this builds into Section 5, staying in the game. Because trading, it's a marathon. So to really figure out if a strategy can survive that marathon, the pros use what are called Monte Carlo simulations. See, a standard backtest only looks at one single historical path. But a Monte Carlo simulation, it takes your win rate and your reward ratio and randomly shuffles the sequence of your trades thousands and thousands of times. It's meant to expose what we call sequence of returns risk. It basically proves that even if you have a fantastic winning strategy, hitting an unlucky streak of losses right out of the gate can totally destroy an account if it isn't sized properly. It literally forces you to fine-tune your risk per trade so you can survive the completely random cruelty of the market.
At the end of the day, position sizing isn't just some dry math problem. It's a critical behavioral boundary. It is the only thing that keeps you in the game long enough for your trading edge to actually play out. So before you click buy on your next position, I want you to look closely at your trade size and honestly ask yourself, are you trading just to win today, or are you trading to survive tomorrow? Thanks so much for joining me on this explainer. Keep your sizing disciplined out there, and I'll catch you next time.